Well, hello, and welcome to another edition of the Concierge Corner. My name is Don Tiegs with IFC National Marketing, and I am your insurance concierge. So picture this. You're sitting with a client who has an estate plan, right? Now, they've got a will, maybe a trust. And as we discussed in an earlier Concierge Corner, they have all of their beneficiaries updated, right? And they feel good about themselves, as they should. But then you ask one question that changes the whole conversation. If you pass away this year, where would the cash come from to pay the bills of death? Right? Like taxes, debts, legal costs, without your family having to sell something important. Because here's the truth. Most estates have a liquidity problem. And as insurance agents, liquidity is in our lane, right? So today I want to help you pre-frame this for your clients using a simple idea. Life insurance is used for many different things. However, life insurance is also a precision tool for estate taxes and estate preservation. Because when a death happens, deadlines actually come up really fast. Federal estate tax filings and payments are generally due within 9 months of death. So imagine that. Families are grieving, assets are tied up, and probate can take time. Yet that IRS clock is still ticking. That's why the families who suffer the most are often the ones who look wealthy on paper, but are cash poor in the estate. Real estate, a family cabin, a farm, a closely held business, retirement accounts, all valuable, but not liquid. Now, you are right in thinking that, federal estate tax only applies above the exemption. But we all know that exemption can change with law. So for those who pass away in 2026, the IRS lists the federal basic exclusion amount at $15 million per person. So many clients won't owe a federal estate tax, but we all know it doesn't stop there. A lot of your best clients get surprised by a state estate tax with much lower thresholds. For example, Minnesota's estate tax exemption is $3 million. And those tax rates can run as high as 16%. And that can impact everyday families, those that have, successful businesses, landowners, retirees with appreciated property. So your client doesn't need to be ultra wealthy to have an estate liquidity problem. They may just have assets that don't easily turn into cash fast. All right. So now let's connect the dots to why life insurance belongs in the estate planning conversation. There really are 3 big reasons, right? First, immediate liquidity. A properly structured death benefit can arrive quickly and create the cash that your client needs to pay final expenses, debts, and taxes, right? Second, tax efficiency. Death benefits are generally income tax-free to the beneficiaries, so the dollars show up when the family needs them the most, right? Third, control and privacy. Life insurance proceeds pass on to beneficiaries and typically avoid probate delays and public exposure, which simplifies the settlement process and reduces family stress. But here's where you can separate yourself from other insurance agents, and that is ownership of the life insurance policy matters. If the insured owns a policy, The death benefit can be pulled back into the taxable estate, which can create or increase an estate tax problem. That's why advanced planning often includes an irrevocable life insurance trust, or an ILIT, right? So the policy is owned outside of the estate, and the trust can control the distribution while helping keep the proceeds out of the estate taxation problem. Planning early is the win. So we're not waiting, right, until the client's health changes or, the client, gets around to it. So now let me give you a simple field-ready approach that you can use this week. An estate liquidity needs conversation that you can have with your clients. So step one, just simply work with your clients, estimate the cash demands at death. The final medical bills, funeral costs, debts, attorney and executor fees, probate expenses, and if applicable, estate taxes and business continuation costs, right? Step two, identify liquid assets already available, cash, CDs, money markets, existing insurance, anything that can be accessed quickly without destroying a long-term plan. Step three, just measure the gap, right? The gap is what life insurance is built to solve. This keeps the conversation practical and client-centered. Remember, you're solving a liquidity problem. So, for example, let's say you're working with a 62-year-old client, married, owns a successful farm business, and has a piece of lake property that's been in the family for decades. So let's hypothetically say their net worth is around $5.5 million. Now, they assume they don't have an estate tax problem, but the problem is they live in Minnesota and their estate tax could be exposed at the state level. And their wealth is mostly illiquid, right? I mean, it's tied up in, business value, real estate appreciation, and if they have retirement accounts, that's illiquid as well. So here's what you can do to help design a permanent life insurance strategy sized specifically for maximum estate efficiency. You can also explore the ILIT ownership structure so the death benefit supports the plan without inflating the taxable estate. That is the real value proposition. Life insurance turns an estate plan into a funded strategy. And if you want a strong one-liner, just try this with your clients. A will tells the court what you wanted, but life insurance helps make sure your family can do exactly that. So here's your action step as an agent. Just add a single question to your annual review process. And that question is, if you died this year, what asset would your family be forced to sell first? And then just pause. Because the answer usually reveals the planning gap instantly. And remember, you're not selling fear, you're selling options. You're selling time. You're selling family peace of mind. So now, if you want help structuring, one of these cases, how to position it, how to size it, maybe how to coordinate with the attorney or CPA, or maybe even how to explain how ILIT ownership works in plain English, just reach out to me at 763-265-3297, and I will help you build the case the right way for the right client with the right professionals involved, right? That is clarity, confidence, concierge. Call me at 763-265-3297, and let's help your clients protect what they've built so their family keeps the assets, not the tax bill. Thank you for watching.